Americans for Fair Taxation presents the Weekly Chairman's Report, written by Steve Hayes, president of Americans for Fair Taxation, and recorded by Bob Paxton, a volunteer with the Florida FAIRtax Educational Association. And now, this week's Chairman's Report.
Hello, I'm Bob Paxton with the AFFT Chairman's Report for Friday, February 13th, 2026. Internal, external, and effective tax rates, understanding the difference. In the world of taxation, the terms internal and external rates describe how the tax is calculated. First, let's look at the internal or tax-inclusive rate. An internal rate calculates the tax as a percentage of the total amount. The tax is inside the number you start with. Federal income tax rates are internal rates, and the FAIRtax rate of 23% is also an internal rate. Let's look at the federal income tax. If you're in the 24% tax bracket, the government takes 24% of your income from your salary. So assume these facts. Your salary is $100,000. Your top tax bracket is 30% on the last amounts you earned. Because portions of your income are taxed starting at 10% and then at increasing rates, you end up owing a total of $20,000 in federal income taxes. That $20,000 is taken from your salary, leaving you $80,000. Now, payroll taxes further reduce that $80,000 by another $7,650. So, federal taxes consumed $27,650 of your $100,000 income. That's an effective rate of 27.65%. Now, in the case of the FAIRtax, the internal rate is 23%. For every dollar you spend on the retail purchase of new goods and services, 23 cents is the FAIRtax, 77 cents is the amount you apply to the cost of your purchase. Now, if you're spending the entire $100,000 on new retail goods and services, $77,000 will go to the retailers and $23,000 in FAIRtax goes to the government. In that case, the FAIRtax comprised $23,000 of the $100,000 you spent. That's an effective internal rate of 23%. Now let's look at external or tax-exclusive rates. An external rate tax is not included in the price of an item. It's added on to a base amount. State sales taxes as we know them are external rate taxes, meaning if you make a $5 purchase in a state with a 5% external sales tax, the price tag on your item will say $5. The tax will be 5% of that $5 or 25 cents, and the tax is then added to the purchase price, bringing your total cost at the register to $5.25. Now, quoted as an external rate, the FAIRtax is 30%. So, if you have a transaction where the retailer keeps $5, $1.50 in FAIRtax will be added to that and paid to the government. So expressed as a percentage of the $5 that the retailer keeps, the FAIRtax amount of $1.50 is 30%. But expressed as a percentage of the $6.50 total you paid, the FAIRtax is 23%. Now here's an example of the external rate calculation for the same $5 purchase under the income payroll tax. Let's say the combined income payroll tax rate is 23%. Converted to an external rate, that's 30%. So, to have the $5 net after withholding, you multiply that $5 by 1.3 and get $6.50. So, in order to get the $5 you need to make your purchase, you must earn $6.50. Now, this is the same cost to the family as the FAIRtax. And when you do this calculation, you see that you're already paying a sales tax because you can only make purchases from your net income. Now let's look at the effective rate. That's the actual percentage of your total income that goes to the IRS. Now, the effective tax rate is the most practical number for a taxpayer when understanding the real impact of the income payroll tax and comparing it to other options like the FAIRtax. So let's look at some income payroll tax examples, first for a single person. Assume that a single person has an income of $116,100 gross. The calculation would be deduct $16,100 from that because that's the standard deduction. This leaves a taxable income of $100,000. The tax is 10% on the first $11,600 or $1,160. It goes to 12% on income between $11,601 and $47,150. That's $35,550. And that works out to a tax of $4,266 on that portion of the income. The rest of that $100,000, $52,850, is taxed at 22%, and that yields a tax of $11,627. Add that all together, and the total federal income tax for this person is $17,053. Now you got to add the federal payroll taxes. $116,100 times the 7.65% payroll tax rate is $8,882 in federal payroll taxes. So this person will pay $17,053 in income tax plus $8,882 in payroll taxes for a total tax of $25,935. Divide that $25,935 by the gross income of $116,100, and you get an effective tax rate of 22.34%. That's how much of that person's total income was consumed by federal taxes. Now let's look at a married couple. Assume a married couple with 2 children earns $70,000 a year. Their calculation is you subtract the standard deduction of $35,100 for them, leaving $34,900 in taxable income. 10% of the first $23,850 turns out to be $2,385, and then the remaining $11,050 is taxed at 12% for a tax of $1,326. Total tax for this couple is $3,711. Now, because they have children, they'll get the child tax credit, $2,200 per child, or $4,400 in child tax credit. Now, their total tax was only $3,711, so the first $3,711 of that credit wipes out their tax liability completely. But since these are refundable credits, the $4,400 credit amount minus $3,711 that was used to pay the taxes means that this family will get a $689 refund. So the final federal income tax for this family is a refund of $689. But they still pay the payroll taxes. Payroll taxes on $70,000 at 7.65% is $5,355. So this family's total federal income payroll taxes owed is that $5,355 in payroll taxes minus that $689 income tax refund, and their total tax is $4,666. So take that $4,666 in total federal taxes, divide by the $70,000 gross income, and you get an effective tax rate of 6.67%. So under the income payroll tax, the single person making $116,100 has an effective tax rate of 22.34%, and the family of 4 making $70,000 has an effective federal tax rate of 6.67%. Now let's look at the FAIRtax effective tax rate compared to the federal income payroll tax rate. Now, once the FAIRtax is enacted, that single person making $116,100 receives his or her entire paycheck. Now let's calculate this person's effective FAIRtax rate. First, assume this person spends his or her entire income on new goods and services. 23% of $116,100 is $26,703. That's the total amount of FAIRtax this person will pay at the cash register. But the FAIRtax family consumption allowance for a single person household is $15,960. That's the amount of spending that is not subject to being taxed. 23% of that $15,960 is $3,671. That's how much of the tax that this person paid at the register will be refunded to them in the prebate. So you take the total FAIRtax amount of $26,703, subtract the prebate, $3,671, and you're left with $23,032. That's how much FAIRtax this person will pay out of his or her own pocket. Now divide that $23,032 by total spending of $116,100, and you get an effective FAIRtax rate of 19.84%. Now that's 2.5% less than the 22.34% effective rate under the income payroll tax system. But note also that the actual fair tax rate will be lower, since it's extremely unlikely that this person will be spending his or her entire income on new retail goods and services. Now, when the fair tax is passed, that married couple we looked at earlier with 2 children earning $70,000 a year, they also get their entire paycheck. And let's again assume that this family spends that entire income on new retail goods and services. For them, the math looks like this. 23% of $70,000 is $16,100. That's how much fair tax they'll pay at the cash register. Now, the family consumption allowance for a family of 2 adults and 2 children is $43,280. Again, that's how much they can spend tax-free. 23% of that $43,280 is $9,954. That's the amount of their refund that comes to them in the prebate. So you take the total $16,100, subtract the $9,954, and you get $6,146. That's how much fair tax this family will pay out of their own pocket. So divide that $6,146 by total spending of $70,000, and you get an effective fair tax rate of 8.7%. Now, this is actually slightly higher than the 6.67% income payroll tax rate, but again, the actual rate will be lower since it's quite unlikely that they will be spending every penny they make on new retail goods and services. In conclusion, while the effective tax rate for the couple making $70,000 is 2.03% lower today under the income payroll tax, this comparison assumes that the present child tax credits remain in place. Now, if the $4,400 child tax credit was eliminated, this family would have an effective tax rate of $9,066 divided by $70,000, or 12.95%. This also assumes the family is spending all of their money on new retail goods and services, and that is seldom the case in real life. So, assume this family spends $10,000 a year for payments on used cars, used furniture, and other used goods. Used goods are not subject to the fair tax. So if they do that, this will reduce the total amount paid under the fair tax to $3,840. So the effective rate in that case is reduced from 8.7% to 5.4%, and that's less than the 6.67% they pay under the income payroll tax. Now let's look at embedded income payroll taxes. This also does not factor the increase in purchasing power when the embedded costs of the income payroll tax system are removed from the price of the goods and services we purchase. Let's assume that prices will only go down by 10%, not the 15 to 20% predicted by economists. This family of 4 making $70,000 will then be able to purchase $77,000 worth of goods and services. The effective rate of the fair tax for that family will be even further reduced. $3,840 divided by $77,000 is reduced to 5% effective tax rate, and the same analysis applies to the single person. Now, while all the alternatives to the income payroll tax system need to be carefully examined, the best alternative is the fair tax, a national retail sales tax on new retail goods and retail services, which provides a family consumption credit so that all purchases up to the poverty level for each family are not taxed. There's no withholding from your paycheck, and you never have to file a tax return telling the government how much you earned and how much you spent ever again. And you'll never ever be harassed by the IRS again because the fair tax abolishes the IRS. Now, many of you have labored tirelessly for freedom from the federal income tax and the IRS. You deserve a great deal of credit for your efforts to educate the American people on the need to fund the American government in a way that's good for America and returns freedom to the American people. It's imperative, though, that we don't replace the current income tax and the IRS with an alternative system that could still be manipulated by the ruling elite. We must let Congress and the President know that the best way to replace the income tax and the IRS is with the fair tax. Now, make no mistake about it. The fair tax is a grave threat to the ruling elites. It will strip them of their power and their ability to control us through the tax system. Their opposition to the fair tax will be fierce and unrelenting. And don't think for an instant they won't use half-truths, deception, and downright lies in their desperate attempts to hang on to their power. However, with the support of this president, we can finally eliminate the income tax and the IRS. Of course, the best course of action is not only to repeal the income tax and abolish the IRS, but to repeal the 16th Amendment as well, so no future administration can ever shackle the American people with an income tax again. We must come together and ensure that real tax reform, the fair tax, is not subverted by the elites in D.C. This will take the diligent effort from all of us. We need your financial assistance and we need your grassroots assistance. Now, if you have contacts that will allow us to get more information about the fair tax to President Trump, please let us know. Please email us at info@fairtax.org and we'll give you some options on how you can best help us. At a minimum, please call your congressional representatives and ask if he or she supports the fair tax. If so, thank him or her for their support and suggest they become a co-sponsor of H.R. 25 if they're not one already. If not, ask why not. Now, if your representative claims to be unfamiliar with the fair tax, offer to have someone come to their office and explain it to them. The solution? Pass the fair tax. Now, why would D.C. pass the fair tax and give up an almost unlimited source of donations? Well, they won't, at least not voluntarily. The only way they will is if the rest of us demand it. Isn't it time to end this ludicrous tax collection system and the IRS along with it? Help us bring about real tax reform and stop future IRS abuses. By contributing or investing $10.40 a month, you help provide a financial base to Americans for fair taxation. Now, if you can make larger contributions/investments, these will be used not for salaries, as we're all volunteers, but for the needed updates to our economic studies, which will be vital for all future years. Please go to FAIRtax.org to invest in AFFT and help us pass the fair tax. It's an investment in your and your family's future.
This has been the Weekly Chairman's Report, written by Steve Hayes, President of Americans for Fair Taxation. Check back every week for news and information about the fair tax and learn why the fair tax should replace our antiquated federal income tax system. If you'd like to receive a copy of the Chairman's Report in your inbox every week, sign up at FAIRtax.org.